Hey everyone, how's it going? You got Cameron Borumand here. I'm based in sunny Seattle right now in the Great Pacific Northwest in Washington. I work at a venture capital fund here in town called Ignition Partners that also has an office in San Francisco as well. And so I'm here to, I guess, talk to you folks, you young people, about what it really means to be in venture capital, what our kind of day to day looks like, and maybe I'll start with a couple things. One, I guess I'll give a quick kind of overview on finance broadly and where venture capital sits in finance. Then I'll dive into venture capital and talk about what the business model for a venture capital firm really is, which not a ton of folks understand. And then I'll talk a little bit about what venture firms do on a day to day basis, which you folks might be more familiar than you think if you watch the show Shark Tank. That pretty much that sums a lot of what we do up on a, I guess, slightly smaller scale, but not often. And then I'll talk a little bit at the end about some examples of companies that we've worked with in our portfolio, and at the same time, how venture firms make money. Uh, so I'm just gonna jump in here. So I imagine most of you folks are high schoolers learning to learning the code. So I'll start a little bit broad with finance in general and kind of my background. I studied at the University of Washington here in Seattle. I grew up in Redmond, Washington, home of Microsoft, and went to high school with one of the folks that's on the leadership team there, Tyler Menezes. And after high school, going to college, I started to get interested in finance, and always had an interest of where money would go, how it would grow and accumulate over time. And then after college, I went into a type of role that's called investment banking. Now, investment banking is a broker that sits in between the people that have money, where I'm at now, a venture capital firm or a private equity or growth equity firm, and the companies that want to raise capital. So I was kind of essentially a middleman or a broker. Did that for 2 years, and kind of made my way onto the buy side, or onto the private equity, growth equity, or venture capital side. So broadly, if you think of broad finance, and if you focus on finance into the places where folks actually invest money into companies, even that's a very, very broad category. So on one end of the spectrum, you have hedge funds that are investing in public companies, a lot of which Apple, Google, Microsoft, to name some of the companies in the tech sector. And then on the opposite side of that spectrum, you have where I sit, and I'm investing. Venture capital firms are investing in extremely early stage companies. Maybe they have 5 to 10 to 20 to 30 employees, sometimes even less. Seed investors, which is the earliest, are even investing in one person in a pitch deck, and you're giving them a couple $1 million for us Ignition Partners. We typically invest about $3 to $8 million in each of the companies that we're working with, for about 20% of the company. So that's on the far left side of the spectrum, and on the far right, like I mentioned, you have hedge funds. So the main difference between these two is hedge funds. All the information is public for the most part. You can go on it online. You can go to a Bloomberg terminal. You watch, Jim Cramer's show, whatever it's called, Mad Money or something, and most of the information is private and is pretty easy to find these companies. So people that really excel on the hedge fund side are folks that can do the kind of quantitative analysis really well, who can crunch the numbers the best, and who can kind of come up with innovative strategies. Now, on the other side of the spectrum where I sit, which is venture capital, it really comes down to finding these companies, because they're not easy to find, um, figuring out what market or broad macro trends you want to invest behind. For us right now at Ignition, we're investing a lot in machine learning, artificial intelligence, and kind of robotic process automation for B2B and enterprise companies. But it's just really hard to find these companies, and it's really hard to get information about these companies because they're not public companies, meaning they haven't registered with the government body called the SEC, and they don't have to send quarterly and annual reports outlining and detailing their business because they're too small and they haven't gone public. So that's kind of the broad spectrum. In the middle, you have growth equity that typically invests in Series B, C, and D rounds. Then you have private equity, which does later stage businesses that'll often, use debt to buy entire companies. Um, uh, and kind of the further right towards hedge funds you go, the more quantitative it gets, and the more towards VC you go, the more qualitative it gets, or kind of people first it gets. I'll give you an example. Even today in our office, we had someone that came in from that was at Uber for 5 years, and he had an idea to start a company in kind of a fintech company. And our jobs is to really, we don't really know much about this guy. There's not much about the company that we know. So how much information can you derive from a 1 hour meeting? The job a lot of times comes down to how reading people and asking them questions to help to see how well they know their market that they're tackling. So there's not a lot of data or numbers that can really be crunched. So that's kind of the broad investing world. As we kind of dive more into venture capital, where I sit, our job is to find awesome companies at the earliest of stages and invest anywhere from, on average about $5 to $10 million for about 20 to 25% of the company. And just taking a step back, Ignition, for example, has raised a $200 million fund. So out of that fund, we'll do about 20 deals. We'll sit on the boards of these companies. We'll help with hiring, customer introductions, really any way we can. And so that, we raise a fund, which is $200 million. We invest that into startups. And then the startups go out, they do great things. And if they IPO or they get bought, that's when we get paid back our money. Hopefully it's a sizable outcome. So I got a question from the chat. What is an early company? That sounds like a lot of money for early. Yeah, that's a really great question. So typically the companies that we invest in, and we'll invest about $6 to $8 million, are around 20 employees, and doing about $1 to $2 million in revenue, growing to maybe $4 or $5 million in revenue. So at the earliest stages, you're really looking for three things. One is the team. What are who are the founders? How long have they worked together? What's their experience and background? What's their drive? What's their hustle? Really kind of what's their unfair advantage to that's going to help them win in this market. And two is the market. Do we believe that this is a market that will get disrupted? And then three is really kind of product. What have they built, and kind of traction. So to answer your question, an early company is about 20 employees, some really impressive senior talent, growing from maybe $1 million or $2 million in revenue to $4 or $5 million in revenue. And we'll come in and do the Series A that's about, on average, let's say $6 million. And we got another question that says, how do you get to 20 employees with no money then? That's a really good question. So there's, sometimes you can get there with no money, but more often than not, these companies are raising a pre-seed round. So I guess the typical times a company raises capital are, you got a pre-seed round. Well, maybe they'll raise, $250 to $1 million. Then you got a seed round. Well, they'll maybe raise $2 to $3 million. Then you'll do a Series A round. That's where we sit. We'll invest about, maybe let's call it on average $6 million. And then a B round is, 12 to 15, and then it kind of grows from there. So if you got 20 employees with no money, that means really one of two things happened. you raise capital from a pre-seed or seed fund to help fund you until you get to 20, or from very early on, you had customers that are paying you for some sort of early product or service that you are giving them. So, that's, you don't see that often these days. That shows that the founders have hustle and have been able to build a product that customers enjoy and like without a bunch of cash, which is a good sign for investors. But typically before we come in and invest that 6, there typically is about 1 to 3 million of prior investment. Hopefully that answers the question, but keep these questions coming as they're great. Let's see, where was I? Right, back to the kind of the R model. So you might be thinking, okay, Ignition has a $200 million fund that it is investing in about 20 companies. Where do we get our money? Where does that $200 million come from? And our money comes from pension funds, endowments, universities. So, for example, University of Washington manages about $5 billion of capital that it's from its employees' pensions, from its real estate portfolio. So, any large bodies that have lots of capital looking to invest, they typically allocate a small portion of that, maybe 2 to 10% into venture capital, as it's a really risky place to put your money. So I won't go diving into too much of that, but we, just like these companies, have to go fundraise from what are called institutional endowments, pension funds, or universities. So we go fundraise, we get our 200 million, we start to invest at the Series A level of these startups, and then let's talk about how we go about that process. What does a day-to-day for us look like? And then post investments, another completely different world. So Ignition, we're about 5 people. I'm an associate on the team, and my main job is to find interesting companies for us to invest in. And we have 200 ready to go. How do we go about finding interesting companies? And there's really a couple ways to do that, and a lot of it comes down to hustle. Do you know the right people that are looking to start companies? Are you in touch with other investors that are maybe seed investors or Series B investors that know companies? So a lot of this VC business is highly network driven. A lot of our best investments came from entrepreneurs that we've worked with in the past that have either started new companies, or they hear of one of their buddies starting a company and say, hey, you should really go talk to Ignition. Those guys and gals are really great folks to chat with. So it's a lot of our leads comes from our network, our ability to hustle and get in front of companies early when there isn't that much information or data about them available. It's so on one hand, it's similar to Shark Tank in terms of we get people coming in and pitch us all the time, but at the same time, the best companies you have to go actively be proactive about finding and getting in front of, because if I'll meet with about 400 companies a year, and we'll maybe do 1 or 2 of those investments. So it's like a sales job, but maybe 98% of the time I'm getting pitched about why I should invest in the business. But that 1 or 2 times a year when I want to invest in the company, you better believe that all the other great venture capital funds in the world, or particularly in San Francisco or Seattle, also want to invest in that company. So then it becomes I'm selling them why should they take my money versus take someone else's money? Kind of like on Shark Tank. But going back to that analogy, when they all figure out it's a hot deal and they start to bid each other up and have competing offers, and then it comes down to who the founder likes the most and who thinks can provide them the most value. So we'll get in. That's kind of called the sourcing process. We'll spend time. We'll identify out of those 400 companies what's the 1 or 2 that we want to invest in. For us, example, we spend a lot of time in machine learning, predictive analytics, artificial intelligence. I just got another question. Do you have any examples of really hot companies everyone wanted to invest in recently? Yes, I do. So this is so there's a company called there's two actually. I'll give you two examples. One is a company called BotKeeper, BotKeeper, based in Boston, that does um, automated outsourced accounting for startups and small businesses and medium-sized businesses. So there's a big trend going on of, how will machine learning or artificial intelligence continue to automate tasks done in a enterprise. And one of the areas that we focused on was the back office, and particularly accounting. So this is a CEO we met. His name is Enrico. That came in and started talking to us about this solution he's built to automate about 65% of what an outsourced accountant does, and still have some accountants on the back end to continue to kind of help train the model, help make it smarter. And as a CEO, sometimes you just want to get on the phone and chat with someone, and so those folks are there to help that. So it's kind of a hot company in the sense that it was AI or machine learning for bookkeeping, which is just a space that's starting to blow up. So we invested about 5 million in their, we called it their Series A about a year and a half ago. The team really started to execute quite well, so they went out to do their next round about a few months ago. And since it was a space that many venture investors identified as, hey, this could be one category that AI and ML could really make a significant difference in automating and augmenting many of these accounting jobs. It caused many of the Series A and B investors to get excited about the opportunity and really pitch Enrico to invest. So at the end, Enrico ended up going with the firms that he was that he had the best rapport with, that he think could have invested in. But I guess that was one example of really a Series A, B level company that is in a hot space with an awesome founder, still early on traction and revenue and customers, but increasingly positive trends that investors were able to rally behind. I'll give you one other example. It's a company called Icertis in our portfolio. What they do is they do enterprise contract management for enterprise. So think about in a large company like a Microsoft or a Google or an Oracle, think about how many contracts there are. Sales contracts, employee contracts, rental, lease contracts. I mean, there's just thousands and thousands of these contracts. And historically, there hasn't been a great way to manage and store these contracts in multiple systems, across multiple offices, across multiple languages. So this is a team that ex Microsoft folks have started here in kind of the Bellevue, Redmond, Seattle area to build a enterprise contract management platform for very large companies. And so very interesting space, because if you think about it, Dropbox Box don't do a great job of managing this stuff. If you're able to build one platform to manage all your contracts, that's a really strong act one. Act two becomes what's actually in these contracts. If we looked at all our sales contracts across the entire company, and we could run analytics on how many times are we discounting, how fast are we getting these deals closed, you can feed back some pretty interesting analytics into the business units. And so these folks are selling large multi-million-dollar contracts to enterprises. So this was an example of a company that strong team, strong space, but they're at scale and doubling every year. So it's kind of like a little bit more on the metric side, really marquee key customer accounts. And so it's like, wow, this thing's starting to take off. Once enterprise software companies get to about 25 to 50 million in revenue and are continuing to double, that's kind of the scale that you start to think, hey, well, this could be a potential IPO in the next 2 or 3 years. And so that creates a lot of investors that want to get in because they start to see that outcome. So BotKeeper, on the one hand, we have a little bit earlier but super strong founder and very, very hot market. On the other hand, we have Icertis, which is a very strong market and an awesome founder, but a little further along in traction, that the investors were like, okay, we can start to see how this thing could potentially be a over $1 billion company in the next couple of years. So hopefully that answered your question. And a lot of times these investors, they get word that a deal is hot, and that word spreads quickly, and then things can get out of hand, and people think, hey, well, if someone at Sequoia is interested in doing the deal, then it must be a good deal because Sequoia is a great investing fund. But really, as an investor, you have to trust your gut, do your diligence, do your work, and be a high conviction investor, and just decide if it's an opportunity that you want to invest in, and not focus on who else is around the table and who else are you competing with. So hopefully that answered your question, but another really great question. So jumping back to where we were, we talked a little bit about the sourcing piece, how I go about finding my deals, the picking the right company. For example, we'll meet with a company. Let's say it's a company in, since we were talking about BotKeeper, an AI or ML for some sort of finance, for financial services. Then we'll go out and say, all right, well, who do these folks compete with? Who else is well funded in the space? Is there anyone that's already raised 40 or 50 or $60 million? It's really executing, that's doing the exact same thing. Are there larger players that really own this market, and would it be tough for them to switch to a startup? Are there super small companies that just getting started that have strong management teams, or raised from strong seed funds? So we'll do a deep dive on the competition. We'll do a deep dive on the market to believe it's to double check it's something that we're excited about and believe in, and we'll do a deep dive on the team as well, and who have they worked with in their past, do reference checks on the founders, and just make sure these are the type of people that you want to be working with, because on average, from Series A to IPO, it takes about 8 years if it happens, and that's longer than the average U.S. marriage. So it's you're really getting married and to these folks in a sense, and spending the next 8 years of your lives with them. So you want to make sure you're picking the right folks. So from initial meeting, there'll be about 2 or 3 or 4, maybe 2 to 3 other meetings. In between, we'll be doing diligence. We'll be asking for docs. We'll go out in our network and talk to our network of companies and see, hey, would you ever use a solution like this? And then towards the end, we'll have them come in to do a partner meeting. We'll call a few of their customers to hear about what got them excited. And from a diligence standpoint, there's nothing more valuable than a customer getting on the phone with the investor and say, hey, this is the greatest thing we've used since sliced bread, or since XYZ. And it's just when you have customers that are using the product and love using it, there's just nothing more valuable for us than to have those types of conversations. And then finally, if we decide that, hey, this is a deal that we want to potentially do, then we'll issue a term sheet to the company that says, hey, we're interested in investing $6 million, for example, for 20% of your company. The company will sign that term sheet, which is a non-binding agreement, but essentially says, hey, we commit to working with you. And then it gets kind of passed off to, at that point, typically we'll have finished our business diligence. It gets passed off to legal, and about 3 weeks later, 4 weeks later, the deal signs, closed, and we wire the money, and it's done. And then that's when the hard work begins. You've done the deal at that point, and now it's like you sit on the board, and it's how do we make this a very big company? As investors, where can we start to help? Can we help with the customers? These are the customers in our network that we think this might be useful for. Can we help with hiring? These are the candidates that might be useful for the open slots you have. We help guide and direct on high-level kind of strategy and initiatives, and just do everything in our power to help make sure that company is successful. And sometimes it can take a while. One of our biggest outcomes was a company called Docusign, based in San Francisco and in Seattle. And that deal took about 12 to 13 years from when we invested to an IPO. But when it did IPO, it was one of the biggest outcomes the biggest outcome for a Seattle venture fund ever. Returned quite a bit of money to our fund, and so sometimes they take a while, and you have to be patient. And we kind of pride ourselves on sticking with the team when times are great, and more importantly, when times are bad. And there's often a lot of tough decisions that need to be made. One of the toughest decisions post investment is, okay, well, fast forward 2 years, the company's made progress, but it's out of cash. What do? They don't have enough progress to go raise from an external source. But are you willing to bridge the company, aka give them more cash? Maybe we invested 6 and we're going to give them another 2 million because we think that buys them another 8 months, and within that 8 months they'll be able to hit the key metrics to raise that next round. So those are some of the tough decisions that as you get down the line with these companies, you have to be able to make. And those can be tough, and they can be tough conversations, and it really comes down to what's the kind of level of trust and communication you have with the CEO and the management team, both ways. How much do they trust you, and how much do you trust them? So it's important to diligence that and develop that relationship very early. And then finally, let's see. Another great question. It sounds like a lot of money. What do companies do with this money exactly? That's a really, really a great question. So typically, if we invest about $6 million in the company, maybe they'll put $2 million of that into hiring engineers. Maybe they'll put $2 million of that into hiring professionals around sales and marketing. Maybe a portion of that will go into their deployment cost, whether it's cost of their cloud infrastructure or if there's a hardware component. And then the other portion of that goes into I can't remember if I mentioned sales and marketing, but it typically goes into sales and marketing, research and development, and then kind of general and operations. So the founders, the management team salaries, and kind of any finance or operations or back office functions you have. But at the earliest stages, the majority of that is going to research and development, and most of that money goes to hiring great engineering talent. So if you folks are young and thinking about startups and learning a little bit about what it means to be on the technical side there, that's where most of the money goes, is to hiring the best software engineers, hardware engineers, mechanical engineers, whatever type of engineers. As they scale and they get product market fit and build a product that they think, okay, enterprises are willing to buy this, then they'll go out and they'll hire a senior, some salespeople to help drive that and facilitate those conversations, and at the same time some marketing folks to get the word out. But at the early stages, vast majority goes to software engineering, and salaries is the big expense there. It's increasingly getting tougher and tougher to compete with Microsoft, Amazon, Google. They're paying so much for software engineers, and these startups are it's just tough to pay that amount of money. Now, these software engineers at startups get often a little bit of equity in the company. So, if the company does really well, that makes up for the delta in cost. But it's tough to compete when engineers are making that much and you're a startup that doesn't, is resource constrained. So a really, really a great question. And so now we've talked a little bit about sourcing. We've talked a little bit about the actual investing picking process, and a little bit about what's it like to sit on a company's board. The last thing is what happens at the end. So there's typically kind of three places that we make money. One is an IPO, which is preferred, which means a company goes public. It's now a public company. There's many more shareholders, public shareholders, and we kind of get paid back our money. That typically happens when a company gets to that, when I talked about earlier, that 25 to 50 million and doubling every year revenue number. The other outcome is an M&A. This is by far the highest percentage of outcomes for venture investors is M&A, which means an acquisition by merger or acquisition by a larger entity. So Microsoft buys them for 300 or 400 or 500 million. Google buys them. Amazon buys them. IBM buys them. There's mega acquisitions like Red Hat and LinkedIn, which are in the 20s and 30s of billions, but the majority of acquisitions are, sub 100, some getting into the 100, 200, 300 range. And for us, if it's a kind of over 500, that's probably a good outcome. We want all of our companies. The math works that we're investing with the belief that each one of these can become $1 billion plus company and return the fund and more. And so if it's it's a $200 million or less outcome, that's depending on the situations might be okay, but not the outcome that we invested in. And the last one is a PE firm comes out and buys maybe 60, 70 or 100% of the, maybe 60 to 70% of the company and buys out your share, and you kind of get cashed out. And so, typically you have the highest multiple on either M&A or IPO. M&A is typically the highest multiple, I think, is on an IPO. M&A is the most likely to happen as these large companies become acquisitive. And then the smaller, the last one we don't see as often. But so if we invest $6 million for 20% of a company and it becomes $1 billion company, we assume we get diluted over time. Maybe that 20% goes to 15 or 16 or 17. But 15% of $1 billion is still about 150. It's still a good. That's a strong return on a $6 million dollar check. Now, that doesn't return the fund. Still, our fund's 200, and we want we're investing in each of these investments to return the fund. So, which means we'd get about 200. Docusign was a lot higher than 200, but you don't get many of those. So that's kind of the. I'll pause there if there's any questions. This job is if you're thinking about venture long term, there's a few paths. I went the traditional finance route and did investment banking. A lot of times folks are going into and working at a startup and really understanding how a startup operates. A lot of whether on the tech side as a developer, software engineer, or as on the operations side. And so there's many different ways to get into venture. It's a fun job. You get to meet with, I meet with 400 of the smartest folks that are building companies that are passionate about it, and their passion and their excitement and their hustle is contagious. So it's a very, very fun job, and I'd highly recommend it for folks thinking about it. We got one other question. You talked about knowing investors was important. How would someone meet someone like you? Well, it's a good question. I think if most of you folks are in, high school or college, use the fact that you're young as an in. Reach out cold. Email is always the best if you can pull their email, or if not, LinkedIn. Go on LinkedIn, see if you have any mutual connections to an investor. If you want to go grab a coffee and just say, hey, I'm interested. I'm in high school or colleges. I'm interested in learning about venture. Most folks, since you're young and you're they'll be helpful and they'll take the meeting. A lot of venture investors are busy, so you might have to get up early or go late or kind of hustle to get in front of them. Follow up. That's one skill I developed later in my life. I wish I developed it earlier. Was, hey, if you email someone and they don't respond, they're not responding because they don't like you. They're responding just because they're busy and they forgot. So follow up every 2 weeks, every 4 weeks. Be creative in your follow-ups. Hey, I saw an article with your name on it, or a company that you invested in, thought it was super interesting. Would still love to connect if you have some time. And so that's how I'd recommend, you folks getting in contact with investors. For me, as I got in this job, we co-invest with a lot of other investors on our companies. So I got to know them that way. I go to a lot of events, so I'll meet other investors at events and I'll get their contact information, and then subsequently do calls. And you start to develop your network of what other investors see deals that align well to your strategy or Ignition strategy, and you become friends. You become close with them. So when I if I see if one of our companies is taking off and doing really well, I got my 5 closest buddies on Series B investors that I'll give a call and say, hey, you got to check this thing out. It's starting to take off. And hopefully I've developed relationships with a few seed investors to where if a couple companies start to take off, they'll do the same. But it's just, you got to be nice and you got to be friendly to these folks. Let's see, one more question. What are some other investors to look for? Not sure I completely understand, but there's quite a few great venture funds. Where we invest is kind of enterprise software, but then there's a whole set of investors that invest in consumer-based companies. Think Facebook, Snapchat, that we wouldn't invest in. We don't invest in apps for consumers. We invest in kind of applications for business users in enterprise. If you Google best venture funds in the world, that's probably a good starting place of some of the biggest outcomes and biggest hits. Sequoia and Andreessen are some of the biggest names in venture, and they've developed kind of top tier reputations. So yeah, there's probably 20, maybe 10 to 20 great funds. So yeah, great questions. Hey, well, look, I really appreciate the time, everyone. Hopefully this session was useful as we kind of dived into a little bit about what venture capitalists do and the way we look at companies and think about companies and partner with them post investment. At the end of the day, the last words that I'll have about venture is, if you like the idea of hustling, finding great opportunities in companies, developing real relationships with CEOs, and thinking broadly macro about who's the best team that's going to win, what's the market that we want to be investing behind, and the technology trends that we want to be investing behind, and 3, what's the unfair advantage or the best product that's going to take this market. I'd recommend venture as a career maybe later down the line in your careers. And for you folks that are young, just be aggressive. That's the one piece of advice I'll give you. Be aggressive. No matter if you want to go into software engineering, finance, operations, venture capital, long term. The world's your oyster. So go figure out what you want to do. Find the people to help you. Be aggressive in reaching out, and you'll get it done. And please let us know if there's any way that I or Ignition can be helpful. All right. Thanks a ton, everyone. Take care.